Hey everyone, how's it going? It is Sunday, October 22nd, obviously well after the market has closed on Friday. I had some family things that I needed to deal with, so I apologize for missing and getting this video out late. But let's go ahead and take a look at what's going on in the markets, how we ended the week last week, and how we're looking as we open up. Of course, we'll take a more careful look on Monday when just a half an hour before the markets open, but for now we can see and plan and maybe get an idea of how we might expect the week to start out. So we closed on the S&P down quite a bit, so we were expecting perhaps a quiet day and perhaps maybe a less directional day. We did not get that. I got that completely wrong. But we did get a very directional day. There was reasonable volume on that day, so we had reasonable volume coming down, downward forces, and then we are now at horizontal support, very close to the MA200 that we've been talking about. Right now, I don't expect that we're going to break through the MA200, but of course, I can very easily be wrong. Right now, we're actually more of a 50-50. There are some things that make me believe that we're not going to go further down, but again, trying to call that is like catching a falling knife. So we don't really want to do that. We want to position ourselves in a way to take advantage whether it goes up or goes down. One of the ways that we have of doing that is what we've been talking about this past week, which was finding strong stocks and going long, and finding a weak stock and going short, and then considering those one position. So if I do really well in one position and I say, hey, I'm going to take profits here and close it, I want to close the other side as well. I don't want to keep it running unless I put on something else to replace the one that I'm closing. So I always want to have these pairs and treat them as a single position and make sure that when I take profits on one, I go ahead and close the other one. But in any case, the S&P is at a decision point. It's got to go up or go down or consolidate sideways. But given on how directional we've been, it doesn't really feel like we're about to go sideways. Let's take a look at our QQQ. QQQ is very similar. We drew this horizontal support. We're very close to it. We're near that MA150, not nearly as weak as the S&P, but we are at a not quite as close to a decision point as the S&P 500, but we are nearing a decision point over here in the QQQ. So overall, NASDAQ is still outperforming the QQQ. And if we look at our industrials are in a similar boat, fell right through that MA200. We're not quite at the horizontal support over here yet, but it looks like we could have a little bit more to go before we reach that decision point of going up or going down. So right now, for the Dow Jones, I wouldn't be adopting that strategy where I go into the strongest stock and go short the weakest stock, because we're not quite at that inflection point. Right now, we have a little bit of downward bias before we hit that support level. So we would wait until we hit that support level before we went in. SPY is ripe. It's ready. It's ready to go. We might go a little bit lower to that MA200 before we make that decision, but we're pretty much ready to go, especially if we look at the SPX. We've already hit and moved through that MA200. So the SPY shouldn't be that far behind. On small cap stocks, we are down. We are clearly down. We're clearly following this trend. So it might be a little too late to try to go into some shorts right there. At this point, we would wait for a pullback before we try to go back in. Much like this pullback to the EMA 20, wave down, hit the EMA 20, wave down. We're going to want to wait till the EMA 8 or EMA 20 and wave down, okay, before we go into a put position in the IWM, or we would see, is this bottoming out and going back upwards? Just because it hits that EMA 20 or EMA 8 doesn't necessarily mean it has to come back down. We have to reevaluate at the time that it actually happens. In terms of our sectors, let's see what happened. Okay, Friday. We must have been looking at discretionary or something on Friday. And You know what, I'll just reload it. It's going to be a lot easier than me trying to figure out exactly what lines of code were changed. So just on Friday, oops, we can see that every single sector is down. Bonds were up. That is positive news that bonds weren't following it down. So there was some flight, it looks like, out of stocks and into bonds. So bonds did not continue its downward slide and putting pressure on stocks. So that's allowing us to balance out a little bit. But we can see that staples fell the least, healthcare fell the second least. So these are two very defensive sectors. But interestingly, retail, which is a growth sector, which is a more speculative sector, is third least. And then we've got real estate, which is kind of neutral, more related to specifically the housing market and interest rates. And then same with home builders. So all of this is where we see the weakness is in financials, in discretionary, and in tech. We saw money coming out of energies on Friday as well. So let's take a look at that, because energy has been strong this whole time. So we have a pullback. So it looks like profit taking and pulling back to the EMA 8. And there's no reason for us to believe that anything has fundamentally changed in the energy sector. We still have the conflicts going on in Ukraine and in the Middle East. There's still interruptions to, and potentially more interruptions to supplies. So this looks like just a nice healthy pullback. As we reached the highs, previous highs, we hit resistance. Now we're pulling back to the EMA 8. So we could consider going it long some energies, maybe coming down to the EMA 20 or MA 50. So we wouldn't want to put 100% of our money or allocation into energies quite yet. Maybe a partial allocation, anticipating that this might bounce back up. So energies is still a sector that we want to pay attention to and potentially go long. If I look on a 1 week basis, energy's right there in the second spot. If I go on a 2 week basis, energy is the number one spot. If I go on a 1 month basis, energy is in the 1 month spot, is in the number one spot. If I go on a 2 month basis, energy is at that number one spot. So really, energy is the strongest sector at this moment in time. And if we're going to go long, then we want to go long the strong sectors. So that's definitely where I'd want to put my focus right now if I was going to go long. And then if I was going to go short, I would be in these F, Y, HB art. So we're going to want to look at the financial sectors on the downside, consumer discretionary, and these real estate, home builders and real estates on the downside. The only one to the upside is probably energies at this point. And we're going to see, is the S&P 500 going to pop up or pop down? So right now, I would say the lowest hanging fruit is in the S&P 500. I could go long the top stock, short the bottom stock. And then I would be looking for maybe short opportunities in the home builders, in the real estate, and in the financials. Specifically, on a longer term basis, I'm going to be looking at those regional banks. But for right now, let's take a look at the all the top and bottom stocks in the S&P 500. So we'll do that real fast. Okay, so Eli Lilly looking pretty strong. CEG, this is an energy stock. So this is healthcare defensive area. So this is a good option. CEG is a good option. Molina Healthcare is a good option. So I might favor CEG just because it is in the strongest sector as well. Although we've seen very good strength in the last day in healthcare, or actually maybe even the last week in healthcare, energy has been consistently strong, so I would favor CEG. And then to the downside, looks like I might, without these loading up, I already know that like AAP's in a retail sector, so I might favor AAP. These are taking a while to load up. Here we go. AAP is looking like this nice, it was consolidating for a really long time and started to wave downwards, and then it popped back up to EMA 20 and come down. Let's look at that in more detail. Yeah, right here. You can see that with very clear, steady downtrend back up to the EMA 20, now moving back down, looking to challenge the lows and perhaps break lower. So AAP is a good candidate. So how would we play these? We would go and we would look at an AAP and say, let's just keep it simple. Let's just keep it simple. I'm going to put in a 42 to 90 day strike. So if I go January, that's 89. That's on the higher end. Lower or farther end, 54 days is a good in between. So I'll choose December 15th. I'll go right at the money and put a put right here, 172.87. So just at the money or just outside of the money would be 175 put. I would go ahead and do that. That would be $7.65, or sorry, $765 invested. So I would want to invest a similar amount for inside. Oh man, I'm looking at Apple. AAP. Here we go. So we're at 51.19. Looks like we're at $2.50 increments. So the $50 strike would be the at the money or just outside of the money, and our minimum investment would be $390. So let's go ahead and do the same thing, except we're going to check long for what was it, CEG. So if I go long CEG, it would be a 345 or 445 investment. That's kind of close. That is maybe a little bit too much above my 390. There's only $50 difference, so that'd be okay. And given the differences in delta, we might actually work out just fine. So I would go ahead and save this trade and say we're going to go long a put in AAP, and we're going to go long a call in CEG. Okay, but I'm going to consider these. Actually, let me rename these. This would be the aftermarket. '22, 2023, and this is paired with AAP. I don't want to consider this trade by itself, meaning that when I exit, I want to exit both at the same time. Okay, and let's take a quick look at what the day trading was like on Friday. So Marathon opened, hit that line that we drew, the blue line, yesterday's close, and then we traded down and through. And at that point, that would have been a confirmation or breakthrough through the bottom level, and you could have taken this trade all the way down. An early entry would be a bounce off of that blue line, but you would have had to be, it's riskier, or a little bit riskier to do it then. This would have been a better confirmation. In Tesla, is that a valid line? Yes, it was a valid line. Okay. And Tesla, we moved up to our upper line right here and bounced back down. So very similar to what we saw in the S&P 500. And we came down and we retested this level. This could have, oh, sorry. We moved up, tested this level, and came down, came up to this second level, and came down. And here, where we broke through and retested, this is a good entry right here. Excellent entry right here. And if I look at my Heikin Ashis, right here, 1, 2, 3, 4, 1, 2, 3, 4, 1, 2, 3, 4, 5 greens. So this would have been we would have caught it to here, which would have been a great trade. That would have been a big winner right there. So that would have been, Tesla was probably would have been our best bet on Friday. And here, Intuitive Surgery down through, this one would have been very difficult to play. Here, bounce off of the purple line right here. Right here, this little green bar right here. And then a bounce off an entry. So this could have been an entry right here. And if we look at our Heikin Ashis, I think it was right here. So 1, 2, 3, 4, 1, 2, 3, 4. Is that a red? Yeah, there's interrupted a green right there. 1, 2, 3, 4, 5. You could have caught this wave right here. Okay, so smaller, not as good as Tesla. And over here in Marathon is difficult. It would have been difficult, but we did wave up to the top, come back down, hit the top again, come back down, and then we bounced off of these bottom lines a few times, and then just kind of hugged this line right here. So no really good entries in Marathon on Friday. So overall, Friday would have been a decent trade day for day trading. And so some people might ask me why I don't day trade. I've only so far shown you one day where I've actually day traded myself. And there's a couple of reasons for that. One, I don't want to feel like it's my job, and I don't want to feel like I'm sitting here staring at the screen. And generally, I have a lot of other things to do that I'm focused on during the day. So I don't often take the time to sit and watch and do day trading. The other thing is, you've probably heard me say many times before, investing is a plan. Trading is a plan. It's not an activity. It is not a product. It is a plan. And day trading moves quickly. So it is more difficult to come up with a solid, fleshed out plan. You have to go with truncated, simple, easy plans. If it goes here, I'm going to go in. And if it goes here, I'm going to go out. And if it goes against the way that I'm going to trade, or the direction I'm trading, then I'm going to exit right here as a stop to protect myself against outside losses. The trading plan has to be very simple because the time frame is short and generally you're acting pretty quickly. So when we are swing trading, we have a lot more time to sit there, plan, develop a full-fledged plan so that we're protected no matter if it goes up, down, or sideways. And maybe I'll start showing more of that process during the aftermarket sessions. But for now, day trading is still great. There's still a lot of opportunities in the market. As long as there's volatility in the market, you'll have a lot of opportunities. When volatility crushes down and gets very low, then there's clearly less opportunities. It becomes a little bit more difficult and you have to be pickier about your trades. But right now, volatility is doing well. So if we look at our VIX, our volatility is up. Even up here in the 12 region where we formed our base, it's still pretty good. So if you started day trading any time in the last couple of years, it's been really good. It's when we get down here in these kind of 9s and 10s where it gets a little too quiet, and you might have some really boring days where you sit there and you wait all day long and you don't get an entry. And you've spent your entire day staring at your screen, waiting and hoping for an entry. So for now, it looks like day trading is a good way to go, but just keep in mind, if we ever hit those low volatility norms that we had back here in 2018, 2019, basically before COVID. We're now approaching right now down here. These are kind of approaching pre-COVID levels. So if you get down into this region, just know that if you're day trading, you might get really bored because you might sit there all day and wait for entries and not get them. Unless you're doing a more aggressive style, you're using Bookmap, you're using level 3, level 4 order trades, then you can always find opportunities. But again, you may be just going for pennies instead of long trends and long runs. All right, so that's going to be it for this particular aftermarket session. I will see you tomorrow in the pre-market, and we'll go over the markets and see how we're going to prepare ourselves for the day.